Hi, gang. Welcome to the channel or the social media platform, whichever you're watching on. Today, we're going to talk escrow shortage. Couldn't be a better time since we're recording this at the beginning of the year in 2024. This is usually when you see the escrow analysis show up from your mortgage lender in the mail, and you may not understand it. You may be reading through it. Some of you, it may mean nothing. Maybe you even get a little escrow refund. Some of you, may be hit with a bill because there's a shortage. And that's what we're going to talk about today because people's mortgage payments magically go up and they think that it was the lender or the realtor or the loan officer. And really, it was none of the above. They're just adjusting the payment for you based on what's owed to your insurance provider and to the county and potentially the city for the taxes that are due for that property for that year. So let's take a look, dive into it here. Again, put a scenario together for you. So let's say you buy a home and your home purchase scenario is a $400,000 loan amount 380,000, and I broke this out because it's important. Let's say principal and interest here is 2402. Let's say property taxes are 250 bucks. Homeowners insurance at 125, PMI at 61, total payment of 2838. Here's where the shortage discussion starts to come in. So taxes due for the year, well, it's 250 bucks per month. Here's the thing. When you close on a house, like let's say you close in February or March, early in the year, well, you're going off of what the taxes are. But however, you won't have the tax bill come out depending on which state you're in till later in the year. So for example, Tennessee and Alabama, a lot of times go out fourth quarter, October-ish is when the bills start going out. In Alabama, you pay it by the end of the year. In Tennessee, you pay it by February 28th, 29th in a leap year. And so that's where we get the number. But what happens? So you can see here, taxes due based on the closing situation. 250 a month means 3 grand HOI, which is homeowners insurance, 125. So it's 1,500 for the year. That's prepaid at closing, though. Okay. So when you buy a home, HOI is prepaid 1 year in advance at closing. Now, when you make your mortgage payment all year long, you send this number to the lender. Well, guess what? That includes taxes and insurance. So when the bills come due in October, November, December, and you make your payment, uh, 12 payments or whatever the case will have been made. Now, if you don't make 12 payments at closing, an escrow account was established for you. And depending on what time of the year it was, that's how many months were collected. So if you closed in March, for example, you don't have as many months collected as you would maybe if you're closing later in the year because the taxes are due at that point and coming up and the bills due. So it kind of depends like on which time of year as far as what's going to be established in your escrow account. So at the end of the year, though, it's all kind of balanced out to where 3 grand and 1,500 will be in escrow and the lender will make the payment. So some of you get a tax bill in the mail, say, hey, I thought I paid my taxes through the insurance or through the loan. You do, but they're sending you just the notification of, hey, the tax bill's out. Copy has been sent to your lender. If you're escrowing, making payments through the mortgage, your lender will pay the bill for you. Nothing to do other than acknowledge. Hey, you don't even have to acknowledge. They're sending it to you for information. So now, let's say though we get towards that end of the year and it's time to pay the bills, pay the insurance, pay the taxes. And generally, your insurance and taxes aren't always due at the exact same time. So it's a little bit staggered sometimes during the year, again, based on when you purchase the home. So if we take a look at it though, uh, what if you end up short? Meaning, okay, you get to the end of the year, the bill comes out, and guess what? The bill ends up being $3,600 for taxes and $1,800 for the next insurance period because we all know insurance has gone up recently in the last year or two. So, what happens if now prices are increasing going forward? Well, the mortgage company is still going to make that payment for you. They're still going to shell out 3,600 bucks if that's what's owed. They're still going to shell out $1,800 to renew your insurance if that's what it goes up to. So here's what happens. You end up short 75 bucks a month. The way we come up with that math, this has gone up $600 Insurance has gone up $300. That's $900 total that they've increased, which means divided by 12, you're short $75 per month in order to make up the gap going forward so that there's enough in future years to make that payment. Now, the other problem is they're fronting you the money to pay these bills. They are going to pay the 600 bucks. They're going to pay the 300 bucks. So they're going to pay the 900 due in order to keep the train moving. But again, that doesn't solve the problem for going forward because you're going to have to make payments to cover the increase. You also owe the mortgage company the $900 that they fronted you. So now your bill could end up going up $100 and $50, which means 150 total. So now in the adjusted scenario, okay, we're not changing loan amount. It'll be whatever you owe. Principal and interest is going to be the same. The terms of the loan are going to be the same. The property taxes are not $350 a month. They're $300 a month. But you have to put in enough to make the payment at the end of the year, for the mortgage company to make the payment at the end of the year based on a $3,600 bill. And you owe them $600 for property taxes from the previous. So that's $50 going forward to cover the increase. And it's $50 to cover the amount that they already paid in advance for you on your behalf. Same concept with the homeowner's insurance. $1,800 instead of $15. This goes up $50, and you can see your whole payment has increased from $2,838 to $2,988, $150 jump in payment. So the 12 payments made are now $4,200 for the year and $2,100 for the year. Once again, that means it's going back to covering the $3,600, and it's going back to the $600 that they fronted you. And it could even be a little bit more, to be honest, because they like to have what's called an escrow pad of a month or two to establish in case of an increase again down the road. Now, if you have money set aside, the mortgage company will give you the option to keep your payment the same. They will let you keep it at $2,838, and then you can just pay out of pocket the lump sum difference for the escrow shortage when doing the escrow analysis. So if you want to keep your payment the same, you can just pay whatever is owed, and then you're okay, but they'll still increase your payment, just not as much because they'll want to cover it going forward. But you could pay a lump sum to keep the payment a little bit more modified. It would look more like this in that scenario where your payment would go up to $2,913. So again, if you get an escrow analysis, if you see that your mortgage payment is going up 99% of the time, unless you have an ARM or a crazy like non-QM loan, hard money loan, something kind of outside the box, your payment is not going to change from the terms of principal and interest or with PMI. But with the taxes and the insurance, if those go up, your payment could go up. And that's what you need to be aware of and understand. So if you have questions about that, send me your scenario. I'll take a look at it, tell you what's going on, kind of interpret it for you if that will help. Appreciate you stopping by the channel. Like, subscribe, follow, hit the bell, comment. Let me know your questions or thoughts. DM me if you want to chat privately. Glad to do that as well. And again, thanks for hanging out. Hope you learned something, and we'll be back soon with more content. Take care.